What's going on, everybody? Shiraz Ahmed here, and today I want to talk to you about the collapse of Silicon Valley Bank and subsequently Signature Bank. This is a serious topic that can have consequences for banks and all of their customers, which is basically all of us. In the finance industry, the jargony term that's used for this is called a run on the bank. So let's dig into what this means and frankly what's happening here. So stay tuned. Okay, welcome back. Now, there's a few reasons why a run on the bank might happen. One of the most common reasons is actually a lack of confidence in the bank's ability to meet its obligations. Now, I'm going to give you an example. Let's say that there are rumors about, let's say, financial instability, or perhaps significant news of like a fraud or embezzlement case. This actually might freak people out, and customers might worry about the safety of their deposits and then ultimately try to go withdraw their money. Now, this leads us to another reason why a run on a bank might happen. It's actually related to the fractional reserve banking system that we operate in. Now, this might actually come as a surprise or a shock, but this system actually allows banks to lend out more money than they actually have on hand, and it's perfectly legal. In other words, for every dollar that's deposited, banks can actually loan out a certain amount more, and depending on what the reserve requirements are, and that's set by the central bank. Now, this system can be super profitable for banks, but it actually also means that they can be vulnerable to a bank run. Now, if too many customers try to take their deposits out at the same time, the bank may not have enough cash on hand to meet all their demands, as they've already loaned out majority of their money or the funds that were deposited. Now, Silicon Valley Bank is a bank that catered to a very specific niche market, which is tech startups, venture capital firms, and really well-compensated technology employees. Now, this bank recently became insolvent and actually has collapsed, leading to fears of a broadening banking crisis. And the news has actually sent shockwaves throughout the entire financial industry, with many experts wondering how this could have happened to a bank that frankly has been serving a very profitable niche market for many years. Now, on a totally interesting side note that I think is actually just important to point out, and it's something that feels like it's totally out of a movie. It turns out that coincidentally, the chief administrative officer of Silicon Valley Bank, Joseph Gentile, also happened to be an ex-Lehman Brothers CFO. And if you recall, Lehman Brothers collapse was actually the canary in the coal mine for the '08 financial crisis. I swear, you can't make this stuff up. So I'm actually going to go over a basic summary of events leading up to this collapse. So it actually all kind of started during the pandemic, when Silicon Valley Bank's deposits grew from $61 billion at the end of 2019 to $181 billion at the end of 2021. Now, this is as a result of startup companies raising tons of VC money. Now, unfortunately, this was too much of a good thing, and Silicon Valley Bank couldn't lend out deposits quickly enough. So it actually began looking for something else to do with this money. Now, unfortunately, a large part of that something else happened to be very long dated, for example, more than 10 years in duration, mortgage-backed securities. Now, Silicon Valley Bank put 56% of its assets into these fixed rate securities, which are far higher than what most other banks would do. Now, whether it was fully or semi-deliberate, ultimately Silicon Valley Bank was betting heavily on interest rates not rising. Now, as a result, interest rates rose pretty significantly, and one-year treasuries, for instance, went from yielding about 0.5% on May 31st of 2021 to more than 5% these days, and the values of these mortgage-backed securities basically plummeted. Now, this led to ratings agency Moody's to downgrade Silicon Valley Bank, and people then started to worry about Silicon Valley Bank itself, and then Peter Thiel and a bunch of other VCs advised many of their portfolio companies to consider withdrawing some of their money out of fears of the balance sheet. Now, many account holders already had started withdrawing deposits in 2022, as funding has already started to slow and they had to draw down on their deposits. So convincing them to withdraw more money really wasn't that hard. So Silicon Valley Bank had to sell already depressed assets at fire sale prices to provide the money for a bunch of their depositors. Now, on a little bit of a side note, Silicon Valley Bank also told people that everything was okay, when really everything was very much not okay, which likely worsened the panic for people to begin with. Now, with $209 billion in assets, Silicon Valley Bank became the second largest US bank failure ever. The collapse has been met with extraordinary steps taken by the US, British, and Canadian governments to prevent a wider spread banking crisis, also known as contagion. Now, at the time of recording this video, regulators have been searching to find a buyer for the bank. Unfortunately, their efforts have been unsuccessful, but the story is quickly evolving, so this might change by the time you see this video. However, depositors have been assured that they will actually have access to their funds. Regardless of the amount of money that they had at the bank, all depositors will be able to access their money. The safeguards will actually be paid out by the fees that the banks pay for deposit insurance, which is run by the FDIC, or Federal Deposit Insurance Company. And by law, they actually only cover $250,000, or the first $250,000. Still, it's important to note that Silicon Valley Bank is actually a business bank, so less than 3% of its depositors are actually going to be covered. Now, since the Silicon Valley Bank announcement, another bank named Signature Bank with $110 billion assets out of New York has also collapsed, making these two banks the second and third largest collapses in US history. So to summarize, the collapse of SVB is served as a reminder of the fragility of the banking system and the need for government intervention, frankly, to prevent a crisis. It's also important to highlight the potential risks that come with banking in niche markets. It really remains to be seen what the impact of the collapse of SVB will have on the broader financial industry. Still, one thing is really clear for us all: the banking system is far from invincible. And all of us, from investors and regulators, really need to remain vigilant to prevent, frankly, another crisis from happening. Now, I want to thank you for sticking around to the end of this video. If you appreciate the content that I've been creating, please consider hitting that like and subscribe button, as it really does help out the channel. If you hit the bell icon, you'll actually be notified the next time I upload a video. I'll also put my contact details at the end of this video. If you have any topic suggestions or questions, please drop me a line. Until next time, please stay safe out there, you all. Bye for now.